It's a real pleasure to be here at Tulane again. This is the best of both worlds for me because obviously I'm a UNO graduate, and last year I worked with Dr. Stroud on a sustainable finance conference here at Tulane, which I hear that they're actually repeating this year. So it's the best of both worlds for me. And I'll bet you're wondering why a person who does personal finance and affordable housing, what I'm doing in the arena of sustainable development finance. In 2009, the Federal Reserve Bank of Atlanta, the Community Affairs Department, had me working on this issue of community development finance as a subject matter expert, and that's how I got into this field. And so what I'll tell you about what we're going to do today is, let me see if I can get this right. So I'm not going to give you a magic wand. I'm not going to sit here and go through pro formas. I'm not going to go through cash flow. We can talk about all of that after this presentation. But what I'm going to try and do is give you an overview of the landscape of the factors that are driving sustainable building development. I'm going to talk a little bit about residential. I'm going to talk more about the commercial piece. We're going to examine the costs and benefits of building green, particularly from a financial perspective, because I think there's a lot of myths that still exist about the cost of building green, and that's something that we fight every day in the financial world locally when we're trying to get these projects financed. We're going to look at some of the existing incentives for building green, and certainly I don't have a whole laundry list of this. I think cost savings alone should be enough of an incentive, and we're looking at that. But nonetheless, there are some other resources that are out there. And in order so that Cliff is going to talk a lot more about the business environment and financing sustainable businesses. And so what I wanted to try and do to give a little bit of context is to provide a snapshot of the venture capital investment in this area, because green is very big in the VC world, not just in the United States, but globally, and you'll see that. And just some key trends in terms of what's happening with green business, how the recession has affected that a little bit. And then briefly take a look at the green jobs sector, because there's all of this conversation now with unemployment about what's the relationship between green jobs, how real is it. I still think we have a lot of work to do in that particular area, but nonetheless, there's some information out there that's specific to Louisiana. So the first thing I took a look at when I started looking at this is, what is the demand for building green? And certainly I think we're seeing more of that in New Orleans. We had a capture point with Katrina wiping out so much of our housing stock and getting all this technical assistance in place. But nonetheless, I found a survey that was done in January of 2008 that is a geographically stratified survey, and it targeted existing homeowners earning $50,000 or more, or retirees with the net worth of $250,000 or more. So we're not talking my affordable housing market that I usually deal with, because we're just looking at what the market will bear at this point. And it was sent to 10,000 potential respondents, and they got a little bit over a 10% response rate, which was pretty good. And so what they found was they asked the following question: how important are the following in your new home purchase? And you could see that insulation, 40% of the respondents said that this was very important, along with home air filtering, water conservation features, energy reduction to some degree was driving it. So you could see that there was a demand for that target market for green features. And so the next question is, are they willing to pay for it? And what's interesting is you saw the insulation came up number one with the demand, but it didn't necessarily translate into them wanting the energy conservation. Here, you can definitely see if it saves them money, these respondents, then they are interested in investing in it. I think we're going to see some of that locally with the new NOLA WISE program. A lot of us are really looking at that. I did a little bit of technical assistance on that program. So I'm really curious to see what's going to happen locally. But nonetheless, this is what happened. Seeing more about the correlation between the built environment and actual health. This is happening more in the public health arena, but on an individual level, I think people are thinking more about that. And then we have the good for environments. And how this breaks out in terms of the market analysis, 34% of the potential home buyers rank the environment, energy savings, or health benefits as their primary decision driver here. I think that that might change. One of the questions is what happens with utility costs going up? What happens with gasoline prices going up? But nonetheless, at the time that this survey was taken, these were who were responding. And so the forest greens are the people that really had an environmental concern, and cost wasn't necessarily that much of a factor. The greenback greens would have been more of those folks that were interested in the cost savings. So it would have been the retirees, et cetera, really driven by the cost savings. We had the healthy greens, which are really looking about 8.5% of the market wanted that type of housing for that reason. But what's interesting, if you look at the sustainable environment, particularly as we look at planning, we look at more empty nesters, we look at the Gen X and Gen Y, they are wanting more sustainable communities, but green in a different way, not only more sustainable in the actual buildings, but sustainable in the way that the cities are built. So you'll see a shift towards more downtown development. People want their grocery stores. They want the, what do we call it, the urban communities anyway. So that's translating into actually the way the whole built environment gets built out. So the next thing I wanted to take a look at is, okay, what's the real cost? Because I kept hearing from my lenders, you ask the lenders, how much on an average do you think it costs more to build green? And there was one study that came back and said, 17% more than stick built. So there's a lot of myth busting that we have to do even amongst the financial institutions about what the real cost is. And I think we're getting closer to maybe net zero on that. But there was a survey out there that showed the green premiums ranging between 0%, which I thought was very interesting, and 18%, with a median of 1.5% increase over traditionally built buildings. So if you're looking over the long-term benefits versus what you're financing up front, you would think that it would be a no-brainer. But one of the things I want to mention is that banks think in the short term when they're making that loan. They don't necessarily look at the long-term viability of the buildings. I think that that's changing, and I'll talk a little bit about what's happening there. And the large majority of these buildings in this study showed a premium of between 0 and 4%. Where you really get down to the zero is that integrated design. And that's something that's coming up more and more as we look at the way that we build our buildings. But it's also a specialty field. I think our expertise here may be growing, but that's very important as we look at bringing green development into our communities. And the typical additional cost per square footage is $3 to $9 per square foot at the time of this study. Great book, by the way, Greening Our Built World taught me a lot about this particular field, if you're interested in that. So another question is, how much energy do green buildings really save? We saw that there was a median reduction of 34%. Again, these are commercial buildings. The range was between 10 cents per square foot to over $2 a square foot. Median annual energy savings of 50 cents a square foot. Present value, so if you're looking at investing money today that you can recuperate in the future, anywhere between $4 a square foot to $16 a square foot. This is what really hit home for me. The present value of 20 years of energy savings in green offices is $10 a square foot, 3 times the reported green premium of $3.40 per square foot. So the money that you put in today, the savings will be reaped as you move forward into the future. And this, again, I think that one of the comments I heard time and time again from people within the field was that energy costs are artificially low. And we're going to see this increase as we move forward into our energy uncertainty environment. So this is something that the financing field is always going to look at. It's something you're going to run up against when you're actually out there doing development. We still have an incredibly difficult time valuing the green premium. What is the additional appraised or fair market value of building green? And part of that is that there just isn't enough body of knowledge to really be able to build up just a database of what the actual appraised values are. There's several different ways that you can actually appraise a building, but this one sort of looks towards fair market as well as what we call the cap rate, the capitalization rate. That's how much it's actually going to cost you in terms of short-term interest. The short phrase is interest for actually building that building. It's kind of a risk premium. But our green buildings have higher rents by 2 to 6%. have higher selling prices by 11 to 13%, and the implied cap rate, 3%, suggests that property investors value the lower risk premium inherent in certified commercial office buildings. These statistics actually came from a presenter who was here at our Sustainable Finance Conference last year at Tulane. And you could see the paper that's referenced down there. But the average non-green building in the rental sample would be worth $5.6 million more if it were converted to green. One of the things I'm going to show you moving forward is that green buildings have actually outperformed traditional stick-built buildings in the commercial real estate space, even during a recession. And so, I think if you look at that value and you look at the ability to provide Class A office space, which makes you more competitive as a community and as a city, as well as how difficult it is to sell commercial real estate in that market, you might think even more about the actual value of building green. So this was the slide that I was talking about. I've got two slides in here that actually compare the different types of green building. You're going to see the green line, obviously, as the Energy Star built buildings compared to the traditional stick-built buildings. And you can see over here that in 2007, 2008, when the recession started hitting and a lot of that commercial real estate was just sitting on the market, our green buildings by far outperformed just our traditional stick-built. So as a lender, if you're looking at risk mitigation, that's also another factor that we have to start building in to make the case for why green is so important. These are direct rental rates, and again, you can see the rental rates that they're actually able to garner as a result of building green. In 2000, and that premium keeps going up, right? So in 2007, right, even at a time when, rates were relatively high because we were not yet in the recession, you had a difference of $3.80, and even in 2009, when we're still in the recession, you have a difference of $4.73. So that premium still holds true for at least the commercial real estate market. We're not sure how that performs in the residential market yet. And these are just some similar comparisons with LEED certified. You can see the difference in 2009 versus $4 is $9. Even more compelling. One of the things I will say about the LEED certification, for more sophisticated financing markets, the lenders, they may not necessarily be looking towards that LEED certification stamp, but what they will be looking for is what are the criteria that go into this building that makes it more sustainable. They're recognizing a couple of things. Number one, there's a bunch of different certifications that you can put out there. And I think one of the challenges for us is the industry has to have a come to Jesus conversation and decide what the standard's going to be, because you're not going to get bankers to be well versed in every single certification. If this is ever going to get to scale, we're going to need to have something that's recognized. The other thing is, frankly, the cost for the certification still is a hurdle and can make or break a project moving forward. So, for example, as I understand it, most of the buildings that the Recovery School District is doing right now are LEED Gold certifiable, but they're not necessarily going through that process because of the additional cost for actually getting that certification for the building. So this is just a little bit about how we get there. This is more for audiences that are actually interested in doing the financing, but these are all the tax credits that are out there available for residential real estate. I can talk to you more about that moving forward, after the break or how we should actually get into the nitty-gritty about that. A lot of people say, well, isn't there a green finance product? No, the issue is not necessarily that you're financing a different type of development or you're doing a different type of financing. You're just having to make the argument for the risk mitigation on that particular and the collateral value of that property in a different way than what we're used to seeing in the traditional financial market. And bankers are very conservative, especially in this environment. They're very careful about stepping outside of that box, particularly when you have the regulators looking over their shoulders. So Not going to spend a lot of time on this. You can use low-income housing tax credits. The Louisiana Housing Finance Agency actually did have some extra credits for building green. You'll notice that the New Orleans Redevelopment Authority and many of their programs have adopted a green standard. So you can actually use those credits and those policies to foster green development in your communities. Of course, we have Cliff, who's going to talk to us about new markets. Specialized lending products that are starting to exist out there, and DOE is doing a lot of experimentation in this this area that I think is going to get us a long way towards getting some real hard data there. So, a few other slides I wanted to go over. This is the trends in green venture capital, because I wanted to see what was happening with investments. So you can see that these are the investments for first quarter 2005 all the way to second quarter 2011. These statistics were taken from CleanTech, which is a group that does venture capital consulting as well as puts together these venture capital funds, etc. You can see that there was a slight decline between the first quarter 11, second quarter 11. Some of the data or some of the literature out there seems to suggest that the why am I blanking out? Solyndra. Yeah, Solyndra. That Solyndra might have had a little softening effect on the market, but nonetheless, pretty healthy. This will show you where the venture capital investments are going. The large hunks are in solar and in energy efficiency, but you can see other areas of experimentation there. What's interesting with this recycling and waste is if you look at the jobs in Louisiana, that's where the majority of jobs are in Louisiana. So I'm wondering, where the research and development is going in Louisiana, where's the venture capital funds in Louisiana when it comes to some of these new technologies. This is just a slide that shows the top 10 venture deals that CleanTech was able to identify second quarter 2011. You can see that 7 out of the top VC deals were done in the US, so we're always worried about that competitive advantage here. We're always hearing about China. Most of what I read seems to indicate that in terms of patents and the research and development, the innovation that's happening, we seem to have an edge, and where China has the edge is in actual production and adopting the technology that we put out there to actually put it out into the market. Whoops, sorry about that. So this is the number of U.S. patents granted by energy category. It's kind of hard to read, but you can see that solar, wind, and hybrid vehicles actually have the largest number of patents that are being applied for out there between 2009 and 2010. So last 2 slides are what's the future of green business. This is a report that's put out by Green Business twice a year, I think it is. And these are responses from revenues greater than $1 billion. What they found in the most recent survey was for those smaller businesses that are below $1 billion in revenues, that they are still being impacted by the economy. So green isn't necessarily top of mind for them, but for the larger businesses, you can see that there are some things that are trending up. So the customer requirements, the green bar is mid-2010. Customer requirements, to some degree, are driving the adoption of green business practices in the corporate field, and then less of the economic downturn. So we're not necessarily hearing that as a factor so much as we move forward. In terms of green jobs, they asked a question, what's happening with green jobs there. Not so much of a hiring freeze this year, and it looks like they're going to increase headcounts. So we've got some trends that are going upward in that area, which I think speaks very well for where the future of green business is in the country. So this kind of shows you, so in terms of green jobs, and here's the challenge I have with green jobs. It's very difficult to count what is actually a green job. And in terms of the higher paying jobs and the kinds of jobs that could lead us to attract more capital and more investment in Louisiana, that's the question that I would have as an economic developer. But nonetheless, a little less than 0.5% of our jobs in Louisiana are green. This is where most of the industries are. Again, sorry, this didn't translate real well. Administrative support and management, construction. I think this is better than what you would see in some other states. wholesale and trade, manufacturing, public administration. This is where I would really be looking for where we were at in terms of having a competitive advantage as a state when it relates to green jobs. But remember, for every engineer that's out there, it takes about three support positions to be able to support that engineer. So when you look at those types of professional and technical jobs, it's not just the engineers, it's not just the scientist, it's also the person that sits behind the desk that types the reports, et cetera, et cetera. And this is actually where the green practices are in Louisiana. So again, you can see the primary lines, the primary industries are the dark green lines, and by far recycling is where we're at in Louisiana with these green jobs. So again, I'd like to see some of that change a little bit into maybe more the research and development.
Okay, well, thanks for having me. I really appreciate it. And I hope Nancy hasn't raised expectations too high by saying I'm interesting, but we'll see how I do here. Amcrest Community Capital, we're a for-profit fund, but we're mission-driven, and we further that mission by using innovative financial tools to create social benefits for communities. And those social goals are promoting sustainable development, expanding use of renewable energy, building green businesses, and assisting low-income communities. And we use a wide range of tools to meet those goals: new markets tax credits, alternative financing, renewable energy tax credits, and various economic development incentives. And plus, I had to do this because it wouldn't be a PowerPoint presentation without a cool graphic. So we're New Orleans-based. We were founded in August of 2005, 2 weeks before Hurricane Katrina. Don't get me started on Katrina stories. There are financial products that we have: tax credit-based investments, debt, equipment leasing, and advisory services. The vast majority of what we do is new markets tax credit financing. We target specifically early-stage and startup projects that are in our service area, which is predominantly the Gulf South, renewable energy, green manufacturers, and particularly early on, people that were helping the GO Zone rebuild, or the Gulf Opportunity Zone, the Katrina disaster area, rebuild smarter and more sustainably. We are a certified community development entity, and I'll explain what that means in a minute. And we've been awarded 5 new markets tax credit allocations totaling $222 million to date. Can't talk about new markets tax credit without telling you a little bit about what it means, and I'm going to try not to get too deep in the weeds at the various financing conferences in my industry. The intro to new markets part of it is an entire day, so I'm going to try to blow through it quickly. But basically, new markets were created in 2000 to encourage investment in low-income communities. And when the program came out, it was really, you look at the time, 2000, it was designed for venture capital for the inner city, to bring funds to low-income communities, markets that were being overlooked. And in order to qualify for receiving new markets financing, you need to be in a census tract with a poverty rate of at least 20% or less than 80% median income. And for the uninitiated, or for normal people, a census tract is, in an urban area like this, it could be 20 by 20 blocks. In a rural area, it could be half a county. It's really population-based and partially geographic as well. So the U.S. Treasury Department runs the New Markets Tax Credit Program and certifies community development entities like us. And then each year we apply, along with hundreds of others, for allocations of New Markets Tax Credits in a competitive process. They're usually about 8 or 10 times oversubscribed. So the New Markets Tax Credits, the actual credits themselves, are equal to 39% of the capital invested or deployed into a low-income community by a CDE. Basically, that means our investors will earn 39% of the investment will accrue to them in the form of a tax credit. And those tax credits are granted over 7 years, 5% on the investment date and on the first and second anniversary, and 6% for the third and sixth anniversary. So if you look at it, it's not a huge amount of money, a 5% tax credit, when you've got a lot of money at risk. So structures have been developed mirroring what's been done for years with low-income housing credits, and historic preservation tax credits, where tax credit investors purchase those credits upfront at a discount to face value. So they might buy $3.9 million of credits over 7 years for $2.8 million today, and that would give them about an 8% yield on their investment. And basically, that all the tax credit investors earn on the project is the right to earn those credits. Typically, new markets are used for large-scale real estate transactions. Until recently, it's changing. It was a majority of new markets tax credit transactions. And so what's eligible are mixed-use projects, retail, commercial, industrial, technology parks, entertainment facilities, that sort of thing. But what specifically excluded is pure residential rental developments. You can have a little bit of residential developments already utilizing the low-income housing tax credits, gaming, and there are other sin businesses, liquor stores, golf courses, suntan parlors. You know, those golfers and those suntan people, just look out for them. You know, what we've always used it for are for business loans or for equity investments in operating businesses. And interestingly, you know, new markets can be used to capitalize for-profits as well as nonprofits. And I'll give you a couple examples of both that we've done. New markets investments, to meet the intent of the program, they have to have positive community impacts. And because of the transaction costs, you know, we've had sets of closing binders this big for a single transaction. The smallest set of closing documents we had was about that thick. So creating that phone book of documents, especially if it's done by lawyers, can be very expensive. So that has driven the per transaction cap pretty high. I would say about the smallest new markets deals that are done these days are about $5 million. We've done deals as small as $1 million, and we would do them small again if the investors would agree to it. But you know, they're looking at getting a lot of money out, and sometimes it's a lot more work to do $1 million deal than it is a $10 million deal. So a little bit talk about our specific investment strategy. You know, I tell people we are a niche within a niche within a niche within a geographic niche. So I kind of lost my little animations here, but that's probably a good thing. So the main thing is, you know, what is our new markets application strategy? When we apply for credits, we state a very specific business plan, and that's essentially to support startup green businesses throughout the Southeast. So you've got to kind of fit that niche. And then there are a lot of programmatic regulations on the new markets tax credit side, treasury regulations. You have to be located in a low-income community, of course. You have to meet other requirements of the program, not be a sin business. And then you've got to make sure that business is going to comply for the 7 years, or the investors could lose their tax credits. The project has strong community impacts. I'll talk more about that in a minute. The investor, you know, have to have the appetite for it. They've got to be interested in it. And, you know, different investors have want to fund different kinds of projects. You know, the new markets tax credit investors are generally just investing for the credits, but, you know, they're also investing for you know, brochure fodder, for reputation risk, whatever you want to call it. Projects that they feel really good about investing in. And different investors want to see different things. And then, you know, the cost and the time considerations. You can spend a lot of money putting together a new markets tax credit transaction, so you need to make sure it's one that will actually close and that everyone will be happy with at the end of the day. Internally, we see a lot of projects, and I might be the worst in our staff, but we get what we call deal crush, where we hear the deal, it's like, oh, we get this big crush on this deal, and, you know, we always want to do the deals that we source or we hear about. And so to take that out of it and make sure we're financing the projects with the strongest community impacts, Susan Segrin, who's worked with us for about 5 years now, came up with this system, and it's really driven us towards better and better quality projects. We rate the community impacts of each project we invest in on each of these 4 pillars. And those are employment, environment, community, and economic impacts. And when I say economic impacts, that's really the economic development impacts to the community. So each of these categories can score up to 10 points, and we total up the scores. If a project is less than 32 points or less than a 6 in any category, we won't do it. Now, it's subjective because it has to be. If we were just doing a single product type, say high performance office buildings less than 2,000 square feet, we can have a very, very specific way of evaluating whether we're doing that deal. But we do everything from bio-coal companies to nonprofits. So it is subjective, and we do debate this kind of ad nauseum sometimes and knock each other's scores up and down a little bit. But what it does is it's created some analytical rigor that's driven us towards putting our tax credits, your money, into the best possible deals. This is our Southeast service area with some of our selected transactions. As you can see, the vast majority of what we've done 8 projects in New Orleans, 3 in Baton Rouge. And if you were to draw a line on if you remember the Gulf Opportunity Zone, it's basically right here. So all but 4 of our transactions have really been in the Gulf Opportunity Zone. Part of that's geography, part of it's the fact that early on we focused specifically on helping with recovery. But a few examples, Abilene, Texas, Broadwind Services, they rebuild wind turbine gearboxes. Harbor Wind just opened a few days ago. It's the nation's first port wind project. And what's interesting is that there's a lot of debate and economic talk about whether it makes sense to go offshore with wind. Well, this is as close as you can get to offshore. It's on the bulkhead. And so you get the advantages of offshore resources with onshore economics, and no one opposed the project either because it's not blocking anyone's sailing view. It's at the port of Corpus Christi, so right behind us a bunch of big cranes that are big in the turbines. Forward Jefferson, this is a project Jedco built. It's there out at the Churchill Industrial Park. Forward Jefferson is a nonprofit. 930 Poydras is one of our only true real estate projects we've done. We did that deal after realizing it had been almost 3 years since Katrina and nothing had gone vertical downtown. And we knew that they needed the tax credits, so we helped put that deal together. Make It Right, we helped, this is an example of a great nonprofit deal where they had a portion of the funds they need. What they found is when the economy went down, the big 7-figure donations kept coming in, but all the little donations dropped off. So using the new markets, they leveraged those big donations to get additional funds. New Biomass Energy, it's a torrefaction project. I'll talk about that a little bit more in a minute. Gulf Coast Agriculture and Seafood, I'll talk about that one as well. Jordan Lumber, we've done a couple deals in the forestry and lumber mill sectors, which, to a lot of people, they aren't green projects, but, some of them really are. Jordan's fascinating. They're considered the best operator in the Southeast. They're family-owned, sustainable forestry business. And the forestry industry is equivalent of LEED. It's SFI, so it is, Sustainable Forestry Initiative. And Jordan was one of the only operators. They were already doing everything but about one thing. They were the easiest implementation of that's been done because it's family-owned. I mean, if they're not taking care of the crop, taking care of the land, they're not taking care of their legacy. Coastal Carolina Clean Power, that's a little business. They converted a very dirty, shut-down coal plant to a biomass power plant. This new biomass energy. This is the U.S.'s first biomass torrefaction facility, which is a bit of a mouthful. I think a lot of people may have heard about wood pellets for energy. A lot of companies the last few years have been setting up to create wood pellets that can be fired alongside coal and power plants to reduce emissions, particularly in Europe. But there are a lot of problems with wood pellets. First thing is they absorb water, so they're often wet by the time they get to the power plant. They don't burn. They don't burn cleanly, and you can only put a small percentage of wood pellets into your coal-fired boiler. So what this product is, it's basically high-tech charcoal. They actually take wood waste, which right now, because there are no paper mills or very few paper mills in Mississippi, is being left on the fields, being left, with the trimmings when they go through every 7 years and clean out the timberlands. They're taking that and they're roasting it. They would hate that I use that word, but they're putting in their special boiler and they're turning it into these charcoal-like pellets. And the advantage of that is they shed water and they can be ground just along with coal and co-fired directly with it. So you can use a much higher percentage. So the project is going to create 90 jobs in a community where Quitman, Mississippi, where there's not a lot going on, and 81 jobs directly in the forestry industry and trucking industries. When they hired their first, when they opened up, they were overwhelmed with their first little job fair, and it stayed that way. Since we did this deal, we financed their first production line. They've now built 4 more. This is Broadwind Services. This is the wind turbine gearbox deal. They let me hold the big wrench. But it's kind of an interesting deal. In Central Texas, there are thousands and thousands of wind turbines and wind farms that are going to go off warranty, basically. And what that means is that the wind turbines, the wind farms can either say, well, we're going to basically self-insure and just buy new gearboxes. Gearboxes are the #1 wear item. Or we can extend our warranty with GE or Vestas, the manufacturer of the turbine, which is extremely expensive. What this company does is they rebuild them. So, if your gearbox goes out, they're going to be out there with the truck and a crane, take your old one, put a new one in there, then take yours back and rebuild it and put it back in their library of gearboxes. And they're located in a closed cruise missile plant in Abilene, Texas. And they're hiring 60 jobs. The city's very excited about the project. And I got to hold the big wrench. This picture's actually funnier if it was in smell-o-vision. It would clear the room. This project is Gulf Coast Agricultural and Seafood Co-op. This is probably my favorite deal we've done in a while. This is a co-op in Bayou Labatt Tree, Alabama. If you saw Forrest Gump, that's where Forrest and Bubba were. And there's a co-op of fishermen, shrimpers, crabbers primarily, who pre-Katrina, they were turning their waste, their shells, their husks. That's 1-week-old shelled crabs that Knox, my partner, standing next to. They would turn that into they would clean it up somewhat and send it out to fertilizer plants. Well, that facility got washed away in Katrina, and they were paying $40,000 a month to haul all this stuff to a toxic waste dump. It wasn't toxic, but nobody wanted it in their dump. I mean, what municipality is going to want thousands of pounds of shells? So it was creating an incredible burden on the co-op members. So instead, they built this facility with the help of a professor at University of Alabama that's actually turning this into a true fertilizer product. And it's, well, they can't call it organic because it's wild caught, which makes no sense. But so they're turning it into a high quality fertilizer product. And what they're doing is they're actually warming it up with heat from solar thermal panels. That's producing methane, which is powering the drying part of the process. So they're close to energy neutral. They're applying for LEED Gold certification, I think, which brings up one point about LEED. We have encouraged the business we've invested in the past not to go LEED if there wasn't a really good reason to. And they had to do it to get a U.S. fisheries grant. But we did a deal, which I'm not talking about today, at Ursuline Academy. It was LEED certifiable, but it would be about $60,000 extra in costs. And you can buy a lot of school supplies for $60,000. And we did something similar with the Bell Chase YMCA. They could fund their community scholarship program for years on that, or they could have a plaque on the wall. For some, if there's not a real reason to do it, we just encourage people to do the right thing, but not spend a lot of money and effort on the certification. And I said that at a U.S. Green Building Council conference and got a lot of. I didn't realize they were a sponsor. I got a lot of bad looks. But this project is creating 17 jobs directly, but it's maintaining the 364 jobs at all the processors that are using the facility.